The illusion of randomness. The most dangerous belief in finance is the belief that crises are accidents, that they arrive unexpectedly, that they are caused by rare mistakes, bad luck, or unforeseeable shocks. History tells a very different story. When you zoom out far enough, financial collapses stop looking like chaos and start looking like clockwork. They follow patterns. They obey incentives. They emerge from the same combination of human behavior and mathematical reality, again and again. Every generation is convinced it has finally outgrown the mistakes of the past. Every generation believes it is smarter, more sophisticated, better informed. And every generation eventually proves itself wrong. The truth is uncomfortable, which is why it is usually ignored. Financial history does not repeat because people forget facts. It repeats because people never change. Greed, fear, optimism, denial. These forces do not evolve. They simply find new vehicles. In the early 20th century, that vehicle was industrial stocks. At the turn of the millennium, it was technology. In the 2000s, it was housing. Different assets. Same psychology. The cycle always begins quietly. Easy money enters the system. Credit becomes abundant. Risk feels invisible. Asset prices rise, slowly at first, then faster. What once felt expensive starts to feel normal. What felt reckless begins to feel reasonable. And then something dangerous happens. Prices stop being questioned. Valuations stop mattering. Debt stops being feared. Warnings start to sound outdated. This is the moment when society tells itself the most expensive lie in finance. This time is different. It is said with confidence. It is said with charts and credentials. It is said by experts, institutions, and media voices who truly believe it. And it is always wrong. Because the system underneath has not changed. Cheap money does not create prosperity, it pulls it forward. Debt does not eliminate risk, it concentrates it. And leverage does not make systems stronger, it makes them fragile. Crashes are not caused by panic. Panic is caused by crashes that were already mathematically inevitable. The collapse is never the disease. It is the symptom. By the time markets fall, the damage has already been done, silently, invisibly, over years of excess and denial. This is why financial crises feel sudden but are never sudden. They are slow-motion events that only appear fast at the end. And today, once again, all the familiar ingredients are in place. Not in one corner of the system. Not in one asset class. But everywhere at the same time. We are not witnessing a localized bubble. We are living inside a global one. An environment where stocks, real estate, and debt have all been pushed far beyond historical norms, supported by the same belief that has preceded every major collapse before it. The belief that the rules no longer apply. That intervention will prevent pain. That markets can be permanently stabilized. History has seen this confidence before. And it knows exactly how it ends. In the next part, we will step back into the past, not to relive it but to recognize it. Because once you see the pattern clearly, it becomes impossible to unsee. And what comes next will feel uncomfortably familiar. The pattern history keeps repeating. Every major financial collapse begins with the same mistake. Not a technical error. Not a single bad decision. But a collective belief. The belief that the past is no longer relevant. In the late 1920s, America believed it had entered a new economic era. Productivity was rising. Technology was advancing. Stock prices were climbing relentlessly. Commentators spoke openly about a permanently high plateau, a market so strong it could not meaningfully fall. Margin debt exploded. Ordinary people borrowed to invest. Leverage became normalized. Risk was reframed as opportunity. Then in October 1929, the illusion shattered. The stock market collapsed. Forced selling accelerated losses. Trust evaporated. Over the next 3 years, the market lost nearly 90% of its value, and the world entered the Great Depression. At the time, the crash felt unprecedented. In hindsight, it was textbook. Fast forward to the early 2000s. Once again, the story was different, and once again, the conclusion was the same. This time, the belief was that housing could never fall nationwide. Mortgages were cheap. Lending standards disappeared. Financial engineering transformed risky loans into supposedly safe securities. Leverage spread everywhere. Banks, corporations, households. Debt became the foundation of growth. When the housing market cracked, the entire structure collapsed with it. In 2008, the global financial system froze. The S&P 500 fell more than 50%. Millions lost their jobs, homes, and savings, while the institutions that created the crisis were rescued in the name of stability. 2 collapses. 2 different assets. One identical pattern. Excessive valuation. Extreme leverage. Widespread belief in permanence. The crash is never the surprising part. What's surprising is how confidently people deny the pattern while living inside it. Each cycle convinces participants that new tools, new policies, or smarter institutions have eliminated risk. But risk is never removed, it is only displaced. And eventually it reappears all at once. This is why the most dangerous phase of every bubble is not the peak, but the period just before it. When volatility is low. When confidence is high. When skepticism is dismissed as fear. Because that is when leverage is highest, and when the system is most fragile. Today's environment mirrors these moments with unsettling precision. But this time the scale is larger. The connections are deeper. The debt is heavier. And the margin for error is thinner. Unlike previous crises, this one is not confined to a single sector. It is systemic. A synchronized expansion across nearly all major asset classes, supported by the same assumptions that failed before. History doesn't announce when it's repeating. It whispers. And right now the whispers are getting louder. In the next part, we'll examine the present moment, and why this cycle may be the most extreme version the world has ever seen. The everything bubble. What makes the current moment different is not that we are in a bubble. It's that we are in every bubble at once. Historically, financial excess concentrates in one place. Stocks in 1929. Technology in 2000. Housing in 2008. Today there is no single epicenter. Equities, real estate, and government debt have all been inflated simultaneously, to levels that, taken together, have no modern precedent. This is what defines an everything bubble. Start with the stock market. Valuations are no longer anchored to long-term fundamentals. Prices have moved far ahead of earnings, productivity, and economic growth. Markets are being supported not by sustainable expansion, but by expectations. Expectations that liquidity will always be available, and that declines will always be rescued. A small number of massive companies now carry an outsized portion of the entire market. Index stability has become an illusion, built on extreme concentration. When confidence holds, this structure appears strong. When it breaks violently. Real estate tells the same story. Home prices in many major cities have disconnected entirely from income. Affordability has collapsed. Ownership has shifted from households to investors. Rising interest rates have exposed how dependent the market was on cheap credit. What was once considered shelter has become a leveraged financial asset. And then there is debt, the foundation beneath everything. Governments, corporations, and consumers have all accumulated obligations under the assumption that low rates would last indefinitely. Debt was no longer treated as a risk but as a strategy. This is the most dangerous phase of any cycle. Because when debt reaches extreme levels, small changes become catastrophic. A modest rise in rates. A slowdown in growth. A single shock. The system no longer bends, it snaps. What makes this moment especially fragile is timing. The policies that once stabilized markets have already been used at historic scale. Interest rates were cut to zero. Trillions were created. Balance sheets exploded. These tools pulled future growth into the present. And now the bill is due. Inflation has returned. Debt servicing costs are rising. Confidence in perpetual intervention is being tested. This is not a warning about a single market correction. It is a warning about structural limits. A system cannot expand leverage forever. It cannot inflate assets faster than reality indefinitely. And it cannot promise stability without consequences. Everything bubble ends the same way. Not because of a specific event, but because the structure itself becomes unsustainable. In the next part, we'll explore why the coming crisis may be more severe than those that came before, and why the institutions designed to protect the system may no longer have the power to do so. No ammunition left. In every previous financial crisis, one force ultimately restored order. Intervention. Central banks cut interest rates. Governments borrowed freely. Liquidity flooded the system. Pain was real, but it was contained. What makes the coming crisis fundamentally different is simple. The tools that once worked are already exhausted. In 1929, central banks still had room to act. In 2008, they had extraordinary firepower. Interest rates were high enough to cut aggressively. Government debt was low enough to absorb massive bailouts. Public confidence in institutions, while shaken, remained intact. Those conditions no longer exist. Today, central banks are trapped between inflation and collapse. Cut rates too fast and inflation reignites. Hold rates too high and debt breaks the system. There is no painless option. Money printing, once seen as an emergency measure, has already been pushed to extremes. The unprecedented stimulus of recent years did not create lasting growth. It inflated asset prices and widened inequality. What was sold as stabilization became the largest wealth transfer in modern history. This has left policymakers with a dangerous dilemma. They must maintain the appearance of stability, even as the underlying structure weakens. This leads to financial repression, keeping interest rates below inflation, quietly eroding savings, and forcing capital into risk just to preserve purchasing power. Savers are punished. Speculation is encouraged. Risk becomes mandatory. At the same time, government debt has reached levels that restrict future action. Borrowing trillions more to rescue markets now threatens a loss of confidence in the currency itself. The crisis has migrated. It is no longer contained within banks or markets. It now sits at the level of the sovereign state. Cut spending and recession deepens. Raise taxes and growth collapses. Print more money and currency credibility erodes. This is not a temporary imbalance. It is a structural trap. And once confidence in the system begins to crack, intervention loses its effectiveness. Markets stop responding to promises. Stability can no longer be purchased. This is why the next downturn will not resemble a short, sharp correction. It will be prolonged. It will be volatile. And it will test institutions in ways they have not been tested before. In the next part, we will look at what actually triggers collapse, and how quickly the cascade can unfold once it begins. The moment the system breaks. Financial collapses are never caused by a single event. They are caused by structures that can no longer support their own weight. The trigger is merely the spark. History shows that when leverage is extreme and valuations are stretched, almost anything can set the cascade in motion. What matters is not what breaks first, but that something does. There are several pressure points in the current system. Commercial real estate stands at the front of the line. Years of cheap financing created assets dependent on permanently low rates and full occupancy. That world no longer exists. Refinancing at higher rates turns marginal properties into losses, and losses into defaults. Regional banks, heavily exposed to these loans, sit directly in the path of this shock. Corporate debt follows closely behind. Companies that borrowed aggressively during periods of near-zero rates now face refinancing costs they cannot absorb. What once looked manageable becomes fatal as cash flows fail to cover interest. And then there are the unpredictable shocks. Geopolitical conflict. Energy disruptions. Political instability. These events do not create the crisis, they reveal it. They force investors to sell not because they want to, but because they must. Margin calls arrive. Liquidity disappears. Prices fall faster than confidence can recover. Once forced liquidation begins, the system enters a self-reinforcing loop. Falling prices trigger more selling. Selling destroys collateral. Destroyed collateral freezes credit. This is the cascade. It moves faster than policy. Faster than headlines. Faster than most people can react. What begins as a correction becomes a collapse. Markets do not decline because people lose faith. People lose faith because markets decline. And by the time panic is visible, the damage is already irreversible. This phase is the most violent part of the cycle, and also the most misunderstood. Observers search for explanations, assign blame, and debate narratives, while the mechanical process continues beneath the surface. There is no negotiation with leverage. It unwinds until it is gone. In the final part, we will look beyond the collapse itself, to what comes after. The wealth transfer. The survivors. And the quiet decisions that determine who emerges stronger on the other side. The transfer and the choice. Every financial collapse is remembered for its destruction. But that is only half the story. Crises do not erase wealth. They move it. From the unprepared to the prepared. From the leveraged to the liquid. From those who believe stability is permanent to those who understand cycles. This transfer happens quietly beneath the headlines. Most people experience a crash only as loss. Falling portfolios. Job insecurity. Fear. Confusion. They are forced to react not because they made reckless decisions, but because they trusted a system that promised stability and delivered volatility. This is how the middle is hollowed out. Savings are eroded by inflation. Pensions fall with markets. Debt becomes heavier as income disappears. By the time clarity returns, assets have already changed hands. But history also shows another group. A smaller group. Less visible. Calm when others panic. They are not immune to fear, they simply prepared for it. They reduced risk when optimism was universal. They held liquidity when leverage was celebrated. They understood that patience is not passive, it is strategic. When prices collapse, they do not ask why. They ask where. Because they know something most people discover too late. The best opportunities never arrive wrapped in confidence. They arrive wrapped in fear. This is not about predicting exact dates or timing the bottom. It is about recognizing the pattern. Excess, denial, leverage, collapse, transfer. The same sequence that defined 1929. The same sequence that defined 2008. And the same sequence now unfolding again. Years from now, economists will debate why so few acted early. Papers will be written. Charts will be drawn. Explanations will be offered. They always are. And they always conclude the same thing. The signs were visible but ignored. History is not unclear. It is uncomfortable. What matters is not whether the cycle completes. It always does. What matters is which side of the transfer you stand on when it does. This channel exists for one reason: to slow the noise, to archive the patterns, to separate signal from distraction. If you want to understand how financial history actually works, not as headlines but as structure, then subscribe to Finance Archives. Because cycles don't warn you when they're about to turn. But if you learn to recognize them, you don't have to be surprised when they do.